Last time I talked about the four major pieces we look at when qualifying someone for a mortgage: income, credit, asset, and the property. Today I want to break down the first one, and that's income. But more specifically, verifiable qualifying income. Because when it comes to getting a mortgage, it's not necessarily about how much money you make. The real question is how much of your income can actually be documented, verified, and used to qualify for the loan. First, when we talk about the employment income, we can generally divide it into two major categories: W-2 income and self-employed income. Today, let's start with the W-2 income. And even with the W-2 employee, it's not always as simple as looking at your paycheck and saying, okay, this is how much you make. We have to look at how you're paid. Are you on a fixed salary? Are you paid hourly? Do you receive overtime, bonuses, maybe even commission? Different types of income. Because there's different types of income, many can look at it differently and will qualify you for a mortgage. Let's start with your base income. Your base income is your regular, consistent income. You might be paid hourly, weekly, monthly, even annual salaries. Doesn't matter how you get paid. The important thing is there a consistent base? We look at the history of that income. Has it been stable? Has it been increasing? Or is it going up and down? If your base income has been consistent or has increased, then generally we have a good foundation for determining your qualifying income. But if the income is changing, we need to understand why. Are your hours changing? Is your schedule changing? Is the income guaranteed? Or does it depend on how many hours you work? Because we cannot always take what you're making today and assume that's the income we can use to qualify you. Now, on top of your base income, you may also receive, as I said, overtime, commission, or bonus. And again, history becomes very important. Has that income been consistent? Is it increasing or is it declining? We look at the history, including prior years, and what you earned year to date. And here's the important part. We don't simply take your most recent bonus, commission, or overtime check and assume you're going to continue making that amount. We look at the history. We look at the trend, and we average that income to determine how much we can actually use for qualifying. So here's what I want you to remember. The income you earn and the income you use to qualify for the mortgage are not always the same numbers. And even W-2 income can get more complicated. What if you work for multiple employees? What if you're a nurse receiving shift differential? What if you're a firefighter working unusual shifts and hours? Those situations can be treated differently.